Welcome back to Creating Wealth Beyond Money here on Relevant Radio 1330, brought to you by Catholic United Financial. We're live at Chanhassen Dinner Theaters today, where our live studio audience will be treated to lunch and Fiddler on the Roof after we make our way through this very informative, great seminar. And it's being put on, again, by Catholic United Financial, with you every step of the way. John Tetzloff is with us. John, why don't you dive back into it along with Margaret?
Sure. Margaret was just talking about, again, the problems we see sometimes if we have an asset that's not easily divided, like a cabin or a piece of property or land, and leaving it to a bunch of different individuals. So, Margaret, maybe you can pick up where you left off there.
Absolutely. So the first thing you need to think about is, what's your vision for the property? Then the next thing you need to do is communicate your vision to the next generation, because you might feel like, I want this property to stay in the family forever and ever, but the next generation might feel like, we just want to sell it. We all live in different parts of the country and we'll never use it, or it's a family farm and it's just too hard for us to manage it or have it managed by someone else. Well, that's really helpful information for you to know right now so that you can plan for it. So once you've got your vision and the vision of the next generation established, then you can look into planning options. And we could go on for an entire hour just about these really good planning options, but I'm going to throw out a couple. If your family feels like, we want this property to be sold, then you can put a directive in your will or your trust that says, immediately upon my passing, I want this property sold. But if one of my, or two, or three, or four of my kids want to join in together and be the ones to purchase it from the estate, then we'll get it appraised at its fair market value, and they can buy it. So they can continue, a small group can continue to own this property if they choose to. We'll give them those options. Otherwise, we'll just order for it to be sold and the proceeds to be divided. Let's just say we want to keep it in the family for a longer period of time, and the next generation is on board with that. A lot of people set up entities like a limited liability company that will then hold that property, and instead of transferring little fractional shares of that real estate down to the second and third generation, you're transferring percentage interests in a holding company that are much easier to transfer and much simpler to manage. An alternative would also be a trust, and that's where you want the senior generation to be doing more of laying down the rules of what's going to happen to this property, whereas an LLC option is much more flexible and egalitarian, and we're all going to get together and run this company together. So those are just two little tidbits, and we could go on, but I know John's got a lot of other things to cover.
Yeah, thank you, Margaret. But that's kind of a neat way to try to manage assets. And we talk a lot about trusts, and you'll see on the screen the different ways that assets can go across. Again, the choices we have as far as avoiding probate. Margaret has mentioned beneficiary arrangements a lot. Keep in mind, again, that all your IRAs, annuities, life insurance, retirement plans have nothing at all to do with your will. If we play cards, we know what trump is. It trumps the will. It goes over the top of the will. So make sure those two things are in accordance. Again, I'm talking to these people up in Thief River Falls this week, and they're very charitable. And they say in their will, we'd like to leave the church, I think, $250,000, whatever the number is. Their probate assets are the house and some cash that doesn't even come close to $250,000, but they have $1.7 million in their IRAs that go to their kids. So the church isn't going to get any of that money because it's beneficiary to the kids, but yet their will kind of doesn't say that, so they don't quite mesh. So with beneficiary assets, we need to remember that's a direct transfer from the insurance company or your retirement plan to your beneficiary. Margaret mentioned a trust, and I have a picture of a bucket there of a living trust. Trusts are very good tools, legal tools to use to manage assets. Maybe I don't want to leave the farm equally to the kids. I want to hold it in that bucket. And I always say kind of create the rule book. I get to create how those assets are distributed, how they're sold. We use trusts, or attorneys use trusts a lot in farming operations where I might have a farming son or daughter and kids that don't farm. How do I make that transition, and how do I make it fair? A lot of people will go with a living trust because they want to kind of get all that stuff out of the way now. And with the living trust, we have some living benefits because if I become disabled and I have assets in the bucket, I can dictate, and my successor trustees can dictate what happens to those assets, even though I haven't passed away yet. Because the trust owns those assets, remember, they're not an individually owned asset anymore, it avoids probate. So I can put assets in a trust today and avoid probate. create that rule book on how we distribute assets over time or all at once, and I can always change it, meaning that it is revocable. So I can manage assets with it, avoid probate, have some living benefits along with that as well. Margaret, anything else you might add as maybe a benefit or a negative to having a revocable trust?
With a revocable trust, I think they're great, and I use them all the time. What you need to do before you decide whether you need a revocable trust or not is take inventory of each and every asset you own and how it's titled, and then decide, maybe with the help of Catholic United Financial or your attorney, is this going to go through probate if I pass away tomorrow? And if it is, then you should consider other options, like the revocable living trust, updating your beneficiary designations. Minnesota, they have what's called a transfer on death deed, which is a deed that you can create now that says, when I'm gone or when my spouse and I are gone, we want this piece of real estate to go to our kids, and it avoids probate. So thinking about, before you decide if a revocable trust is right or not, thinking about every single asset you own and how it's titled and what would happen to it tomorrow.
Yep, great point there. Now, I want to make sure, too, I hear a lot of folks say, well, I have a trust, so my assets are protected. They are not. Because it's revocable, we can change things. You'll see the red on the screen there. There is no protection from nursing home in a revocable trust. It's still an asset that it is yours. You own it. If you have a bill at the nursing home, those assets should and can be used to pay the care. It is also not a tax planning trust. There's no tax benefits really for a revocable trust. You still pay income tax like you normally do. If you sell an asset, you still pay capital gain, all of that type of thing. It's still part of your estate for estate tax purposes. So if I put my farm and my cabin and my house and all my cash and all my investments in that trust, it's still part of my estate at death, which counts towards those estate tax rules, which is a very good segue to the next section, which is the estate tax issue. There's both a federal estate tax and a Minnesota if you're a resident of Minnesota. And the federal government avoided the fiscal cliff a couple years ago by raising the exempted amount of assets at the federal level. So this year it went to $5,340,000, which means that your total estate at death, if it's less than $5,340,000, you pay no federal estate tax. Now that's both husband and wife if you're married. So spouses can actually at the federal level pass $10,680,000 of assets across the river to their heirs without a federal tax. So that kind of kicks out a few people. Another thing I want, everybody in this room probably has that issue, but we never know. The other thing I want to mention as it relates to Minnesota is portability. And Margaret, maybe you can explain portability, because that's a fairly new concept in terms of federal estate tax planning.
Mm-hmm. So portability is the ability of one spouse who's surviving to use the federal exemption of their deceased spouse. So you have a husband and wife, the husband passes away. The wife files an estate tax return and says, I've got all these assets, and I have $5 million of exemption, it's probably going to cover it, but I'm going to reserve the right to use my deceased husband's $5,340,000 federal exemption when I later die. But you have to file that estate tax return in order to use the deceased spouse's exemption amount. No. Minnesota does not have portability. So in Minnesota, each person, and John will probably cover this, each person has $1 million exemption from Minnesota estate tax. But if you pass away and you leave everything to your spouse and you don't use up that $1 million when the first spouse passes away, the surviving spouse has no way of using that $1 million. The $1 million is gone. So tax planning that utilizes each spouse's $1 million from Minnesota tax is still alive and well in Minnesota.
Yep, and I'll show that on the screen. That portability is really cool, again, because you can go back and get that. You know, I use an example. Let's say my spouse dies and she's worth, $2 million. And we file an estate tax return, things pass to me. I die, 20 years later, and my estate's $7 million. Well, now I'm over the $5 million. Well, I can port her $2 million, correct? Back into mine, and now I got $9 million exemption. So it's kind of a neat thing, and the only requirement is you file an estate tax return. Well, where Minnesota differs on one thing for sure is that exempted amount. Minnesota says we only will allow $1 million to pass across that river without a Minnesota tax. And what is it now, about 10 to 15, 16%, depending on the amount of assets?
Average is around 10% until
Okay.
you reach a higher level. And then
Higher level. So anything over $1 million is taxed then at the Minnesota tax rate. Again, both spouses get that, or everybody in this room gets that exemption. But like Margaret said, there's no portability. So you have to plan ahead to make sure that you use both those credits that are available. I'm always about examples. Here's mom and dad. Each spouse is worth $750,000, so they have $1.5 million together. Dad dies with the simple plan. He says, I'm just going to leave everything to mom. Well, in Minnesota and the federal level, you can leave any amount to your spouse without a Minnesota or federal tax. So I could be worth $1 billion and leave it all to my spouse, I suppose, and not pay any, or my estate doesn't pay that tax. It's unlimited. But what I did is I gave up that $1 million credit in Minnesota because I can't use both. So now I have a problem, or she does anyway. There's no estate tax at my death, but she now has the total $1.5 million in her name. That's not even including any growth that she might have between my death and hers. But now she's 1.5. She uses her $1 million. Well, we're $500,000 over. It's about a $64,000 tax that my kids got to pay in cash within 9 months of my death. So what did I do is I didn't use that credit. I gave it up because I didn't plan ahead. My spouse can't go back and port it over like we can at the federal level. So what a lot of attorneys will look at doing is creating another bucket that deflects that $1 million. So this guy's will now would say, or trust would say, upon my death, leave whatever amount of assets I have in my name into a trust. Do not give them to my spouse. Well, now I can apply that $1 million credit to my estate. It goes down into that credit shelter trust, and my spouse actually gets the income from that asset for her lifetime, which is kind of cool. It's also protected, if nursing home comes into play for my wife, they can't come after that asset because she never owned it. Now, they can get the income that it produces, but it's a protected asset.
And it's also not required that you give the income out.
Okay.
You could leave that in the credit shelter bucket. You could leave that in there forever and just give the wife the access to it if she should need it, but otherwise leave it in and let it grow.
Yeah, cool. The other nice thing about that is that if there's any appreciation on that asset, so let's say a farmer puts a farmland in that, gets his $1 million credit, wife doesn't die for another 10 years, now that land's $3 million, and it passes out to the kids. That appreciation is locked into that trust, so there's no estate tax on that trust coming out to the kids. So it's kind of cool. But now we go back to this. Remember, nothing came from dad now. It's all sitting in that trust. Well, mom's estate, again, assuming her estate doesn't grow, is $750. Nothing came from dad. Her estate's $750. She uses her $1 million credit. We zeroed out the estate tax in Minnesota. Now, mom dies. Her assets go to the kids. The trust disperses to the kids, depending, again, on what a person's wishes are. So it's kind of a really simple, easy way to plan. Now, if your estate as a married couple is over $2 million, we still can only deflect $2 million. So now our strategies change a little bit, and we talk about, well, what is our options? We can try to lower the value of our estate so that when we die, we don't have to pay it to Minnesota. It goes to our church or our kids as we get it out of our estate or lower it. Or we find the cheapest dollar possible to pay the tax. So the kids don't have to go sell land or sell the cabin or cash in an IRA to pay estate tax. I'm going to create an entity. A lot of times people use life insurance to do that, to pay that bill. And it's liquid cash, tax-free, ready to go. So there's a lot of different strategies there. Margaret, can you kind of add something to that? And then we're going to wrap it up for Brian here.
Sure. Minnesota, one thing that John mentioned that I think is important that ties into the current tax laws in Minnesota is is gifting assets out of your estate. So that couple, that wife in the first example where she has the $1.5 million estate because she didn't do any planning, she could gift away $500,000 of that and then only have $1 million left. But what ends up happening there is that now there's a Minnesota gift tax. So if she gives away the $500,000 and then passes away within 3 years of making that gift, the $500,000 gets pulled back in her estate. If she survives the 3 years, however, that $1 million that she gave away she's survived the 3 years, the $500,000 is gone, and she still has $1 million exemption to leave at death. So Minnesota's gift tax makes some of that planning, if you have that over $2 million, or if you haven't done the planning and a spouse has passed away, a little bit more complex, but it can still be done.
Yeah. They call that post-mortem planning right after the death. So, all right, I'm going to end here real quick, and then we'll get Brian up. What are the steps in planning? The first two Margaret already talked about. You got to know what you got. You know, all these assets play by all these different rules. How am I supposed to know as an individual or couple how these pass and where they go? So what we do is we help people gather information. Step two, John Ginther, Ryan Selleck, myself, work with folks to kind of take that big picture. Say, here's what you got, and here's the things that all make sense based on your wishes and all the different rules. Then we usually get folks to the attorney or the accountant to prepare any legal work or the trusts or the LLCs or that type of thing. The beauty of that, and Margaret says this all the time too, is it makes her job a lot easier if step 1 and 2 are already done before you go see that attorney. A lot less time spent gathering facts, and you know a lot of the things that are happening as well.
Absolutely.
Yep.
You can lower your attorney bill if you're really organized on 1 and 2, and Catholic United will meet with you for no cost to help you get organized, and that's pretty neat.
Exactly. And then the last section, and Brian will step in on this as well, we're also going to talk about long-term care planning, health care planning for folks. What are the tax issues? Not only estate tax, but how about income tax and capital gain tax and all those fun things that we have, all the way down to the last expenses. Do I want to, when I pass away, make my kids have to decide and come up with the money and things for my funeral and stuff? No, I really don't. I want to take care of that ahead of time. Okay? So thank you for listening to Margaret and I, and then after the break, we'll bring up Brian LeClaire that will talk again a little bit about health insurance and health care issues.
You're listening to Creating Wealth Beyond Money live from Chanhassen Dinner Theaters this morning here on Relevant Radio 1330. Thanks to John Tetzloff, and also thanks to Margaret Cronin. Our seminar on estate planning and long-term care services continue. We'll talk with Brian LeClaire from LeClaire Insurance about long-term care insurance back in a minute on Relevant Radio 1330.